Hi, I'm Aaron Dunn. I'm Senior Equity Analyst at Keystone Financial, and I have over 10 years' experience researching and recommending stock investments to individual and institutional investors. One thing clients have talked to me a lot about over the years is investing in the US market for Canadians. People want to know if it's necessary, why it's necessary, and whether or not it's just better to take the simple approach of keeping your capital in your home country. The answer to this question is that it is important to look outside your home country for potential investment opportunities, particularly for Canadians. I'm going to tell you why. I want you to think about something for a moment. In 2017, Canada's economy is expected to grow at the fastest pace in the G7. It's expected to grow at the second fastest in 2018. Yet the Canadian stock market year to date is ranked dead last amongst G7 members. So in spite of having one of the strongest economies in the developed world, our stock market actually has the worst performance. Here's a comparison of the performance of key stock market indices in G7 countries as of October. You can see Canada ranked right there at the bottom, dead last. Even below the UK, which is supposed to be reeling from Brexit. And well below everyone else, all of who are in the double digits. So how does that make sense? Take a look at this. This is the Canadian stock market broken down into sector categories. There's financials, resource, industrial, utilities and pipelines, consumer products, communications and media, real estate, technology, and healthcare. Do you see a problem here? The Canadian stock market is incredibly and excessively concentrated. Just look at the weightings. Over half of the market is in two sectors, financials and resource stocks. There just aren't enough options. The financial sector, over half of that sector is just our big six Canadian banks. And resources, those are primarily mining and oil and gas, commodity businesses which are highly volatile and very risky. So close to half of the stock market in Canada is six banks and a bunch of high-risk commodity stocks. That's a problem because it makes the Canadian market hard to invest in, both for Canadians and for international investors. But what I dislike most about this chart? Just think about it for a second. We live in a world that is driven by rapid technological change. All of these opportunities being created in AI, big data, Internet of Things. Now look at where our technology sector ranks on the list. 8 out of 9. 3% of the market. Barely a blip. This is the same data for the US stock market. Right away is much better diversity among the sector categories. Looking at technology, right up at the top of the list, 19% of the market. People go to the stock market for growth. The technology sector is a producer of innovation and growth. It only stands to reason that the sector should be an important part of the stock market. In the United States it is, in Canada it isn't. Putting these markets side by side illustrates the difference. There's much more diversity and quality in the US market than what we have up here in Canada. Scaling the two markets side by side really shows the difference. You can just see how many more potential opportunities there are south of the border. Think again about the importance of technology and look how that sector in Canada is barely visible when put alongside the US. That really gives a sense of how many more potential opportunities there are to invest in by expanding your horizons to the US market. Not at least considering the United States puts most Canadians at a big disadvantage long term.